Okay, so you want to own a crypto exchange. On the surface, this looks like one of the best businesses ever invented. You don't take a directional bet on whether Bitcoin goes up or down. You just sit in the middle and collect a small fee every single time someone else trades. And when it works, it prints money at a scale most industries never see. But underneath that fee-collecting simplicity is one of the most operationally dangerous businesses in finance, where the same feature that makes it profitable, holding other people's money, is exactly what can destroy it overnight, with almost no warning between looking perfectly healthy and being completely insolvent. Let's talk about how you'd actually start this, because almost nobody's first move is a global exchange with its own matching engine and its own cold storage vaults. And pretending that's the starting point is how founders blow through capital before they've proven anyone wants to trade with them. The realistic entry point looks much smaller, either launching in one specific country or niche asset category first, where the licensing burden is narrower and the competition thinner, or using white-label exchange infrastructure and a regulated third-party custodian rather than building your own matching engine and cold storage from scratch on day one. Plenty of real exchanges started this way, essentially renting the hardest, most expensive parts of the business until trading volume justified building them in-house. The actual first practical step, before any trading feature ever goes live, is securing the licensing for your specific target jurisdiction and deciding, explicitly and in writing, how customer funds will be segregated from company funds, because retrofitting that discipline after the business already has volume and pressure on it is exactly how every collapse in this industry's history happened. Compliance and a qualified custody relationship are the first real hires, not features you get to later once things are working, precisely because later is when the temptation to blur that line is strongest. The single most common and most fatal mistake, seen over and over across this industry, is treating customer deposits as available working capital even briefly, to cover a shortfall or bridge a gap, on the theory that it'll be paid back before anyone notices. It is the exact mechanism behind nearly every major exchange collapse this video covers, and it starts small, as a temporary, reasonable-sounding exception every single time. Let's start with how the money actually comes in, because there are more revenue streams here than people expect. The core engine is trading fees, typically a fraction of a percent charged on every buy and sell, usually split between a slightly higher fee for market takers, who remove liquidity from the order book, and a lower fee for market makers, who provide it. On top of that, exchanges charge listing fees to new token projects desperate for exposure to a large user base, sometimes running into the millions of dollars for a prominent listing. There are fees on margin and futures trading, which often generate more revenue than ordinary spot trading because of how much volume leverage traders push through relative to their actual capital. There are withdrawal fees, and increasingly, cuts from staking services, where the exchange stakes customer crypto on their behalf to earn network rewards and takes a percentage of the yield before passing the rest back to the customer. When Coinbase, one of the few publicly traded exchanges and therefore one of the few whose numbers we actually get to see in detail, reported financials during the height of the 2021 bull market, it posted over $7 billion in annual revenue and more than $3 billion in net income, almost entirely from being the middleman on trades. That's the business working exactly as intended, at exactly the scale that makes people want to get into it. But building that middleman position costs an enormous amount before you ever collect a single fee. Regulatory licensing alone can be a multi-year, multi-million-dollar undertaking, because you typically need money transmitter licenses in every jurisdiction you operate in, and in stricter markets like New York, a specific and famously difficult bit license that has taken some applicants years to secure. Compliance isn't a department in this business. It's practically its own company inside the company. Know your customer identity verification on every user, anti-money laundering transaction, monitoring running continuously in the background, transaction surveillance systems flagging suspicious activity, and a legal team large enough to handle the constant stream of regulatory inquiries that come with operating in one of the most scrutinized industries in the world across dozens of overlapping jurisdictions that don't always agree with each other on the rules. Then there's security, which is arguably the most important line item on the entire balance sheet. You need custody infrastructure, meaning cold storage systems, to keep the vast majority of customer assets completely offline and physically isolated from the internet, away from hackers who are constantly probing for weaknesses. You need multi-signature wallet architecture, requiring multiple independent approvals before any large transfer can move, and often insurance policies to cover what happens if something still goes wrong despite all of that. And something going wrong is not a hypothetical in this industry. It's the industry's defining, recurring risk. Mt. Gox, once the largest Bitcoin exchange in the world, collapsed in 2014 after losing roughly 850,000 Bitcoin to a hack that had apparently been draining the exchange slowly for years before anyone caught it. That single event, from over a decade ago, is still cited constantly because it established the template every subsequent disaster in this industry has followed in one way or another. The assets customers thought were safely held simply weren't there anymore by the time anyone checked. There are also fees most customers never think about at all. Withdrawal fees on moving crypto off the platform, spreads built into the convenience, with a card flow aimed at newcomers who'd rather pay a premium than learn how an order book works, and increasingly, revenue from lending out customer assets to institutional borrowers at interest, a practice that only works, again, if the exchange is honest with itself and its customers about which assets are actually available on demand, versus which are temporarily out earning yield elsewhere. Let's put real numbers on what it costs just to open the doors. A serious licensing and legal push across a handful of key jurisdictions can easily run into the tens of millions of dollars once you count lawyers, compliance consultants, and the capital reserves regulators require you to hold and prove you can access. A production-grade trading engine capable of matching orders with the speed and reliability serious traders expect is typically a multi-year engineering effort, with a team of experienced engineers costing several $1 million a year in salaries alone. Custody and security infrastructure, including audits from specialized crypto security firms, penetration testing, and insurance, adds millions more before you've onboarded a single customer. And then there's ongoing compliance staffing, often dozens of people dedicated purely to know your customer checks, transaction monitoring, and responding to law enforcement and regulatory requests, a cost that scales with your user base rather than shrinking once you're established. Realistically, a serious, licensed, secure exchange is not a weekend project or even a well-funded startup's first year of spending. It's tens of millions of dollars before the business has proven it can attract enough trading volume to justify any of it. Because here's the fundamental tension sitting at the center of every crypto exchange. Customers are trusting you to hold their money, sometimes billions of dollars of it, while you simultaneously have enormous incentive and enormous practical ability to use that money for other things, whether that's covering a shortfall, funding expansion, or propping up a related business. Every major crypto exchange collapse in history traces back to some version of that same conflict between what customers believe is happening to their money and what's actually happening to it behind the scenes. Which brings us to FTX, the clearest and most consequential example of that conflict in the industry's short history. By 2021, FTX was one of the largest and most trusted exchanges in the world, built by Sam Bankman-Fried, backed by major venture capital firms who had done extensive due diligence, with a Super Bowl ad and a naming rights deal on an NBA arena in Miami. It looked, from the outside, like the adult in the room of a chaotic industry. The exchange serious institutional money felt safe using. In November 2022, a leaked balance sheet revealed that Alameda Research, a trading firm also controlled by Bankman-Fried, was sitting on a massive position built largely out of FTX's own token, FTT, rather than real, liquid, independently valuable assets. Once that became public, customers panicked and rushed to withdraw their funds, a classic bank run. Except this time it revealed something far worse than simple illiquidity. FTX didn't have the money. Roughly $8 billion in customer funds had been commingled with Alameda Research and used to cover its trading losses and other obligations, money that customers believed was sitting safely in their accounts and was never supposed to leave those accounts in the first place. FTX filed for Chapter 11 bankruptcy on November 11, 2022. Sam Bankman-Fried was convicted on multiple fraud charges in November 2023 and sentenced to 25 years in prison in March 2024. One of the most trusted names in the entire industry turned out to be, at its core, a business that had quietly stopped separating its customers' money from its own, and nobody outside the company knew until it was already too late to matter. That collapse crystallized the single most important lesson in this entire industry. Segregation of customer funds isn't a compliance checkbox buried in a terms of service document. It's the entire foundation the business either genuinely stands on or doesn't. An exchange that keeps customer assets truly separate, truly liquid, and truly available on demand can survive a bear market, a hack attempt, even a wave of bad publicity. An exchange that quietly uses customer deposits to fund its own trading, its own expansion, or its own emergencies is running a business that looks completely fine, right up until the exact moment it isn't, with essentially no warning in between for anyone on the outside. It's worth understanding just how tempting that line is to cross, because it explains why this keeps happening across different companies and different eras of the industry. A crypto exchange sitting on billions of dollars of customer deposits is, functionally, sitting on an enormous pool of float, similar to how an insurance company holds premiums before claims come due. That float is genuinely useful capital sitting there, seemingly idle, and the temptation to deploy even a small percentage of it into the exchange's own trading strategies, or to bridge a temporary cash flow gap, or to fund a new business line, is enormous, especially when the exchange's own leadership is confident in their own trading ability. The businesses that survive long-term are the ones that treat that temptation as something to be structurally prevented through hard rules, segregated accounts, and independent audits, rather than something to be managed through good intentions and internal trust, because intentions don't hold up under pressure the way structural separation does. Regulation in this industry has also been a moving target, which adds its own layer of risk on top of the custody question. Different countries, and even different states within the U.S., have taken wildly different approaches, from broad bans to detailed licensing regimes to a kind of watchful ambiguity where exchanges operate without clear rules and hope enforcement doesn't catch up to them. That regulatory uncertainty is itself a cost, because it means legal and compliance strategy has to be built to survive rule changes that could arrive with very little notice, and exchanges that gambled on staying in murkier jurisdictions to avoid licensing costs have repeatedly found themselves on the wrong side of a sudden crackdown. There's also a conflict of interest baked into the listing business that's worth understanding, because it shapes incentives in ways that aren't always visible to ordinary traders. Exchanges routinely take equity stakes or token allocations in the very projects they later list, meaning the exchange has a direct financial interest in that token's price going up and in as much trading volume as possible flowing through it, which isn't necessarily the same thing as that token being a good or safe investment for the retail trader clicking buy. This has drawn sustained regulatory scrutiny over the years, because an exchange that's simultaneously the marketplace, a major shareholder, and sometimes even a market maker in the same token is wearing several hats that can quietly pull in different directions from what's actually best for its customers. So what actually separates a crypto exchange that survives for a decade from one that becomes a cautionary tale referenced in every documentary that comes after it? It's almost never trading volume or brand recognition, both of which FTX had in abundance right up until its final weeks. It's proof of reserves and real asset segregation, meaning customers and independent auditors can actually verify that deposited funds exist and aren't secretly being used elsewhere. It's regulatory relationships treated as a genuine, ongoing cost center worth investing in seriously, rather than an obstacle to minimize or route around. And it's a boring, disciplined treasury function that resists the single temptation every fast-growing exchange eventually faces: using the float of customer deposits to fund something, anything, that isn't sitting there ready for customer withdrawals. So if you're actually weighing whether to get into this, the honest starting playbook looks almost boring next to FTX's Super Bowl ad and arena naming rights. Pick one narrow jurisdiction or niche, get properly licensed there before a single trade executes, use an established custodian rather than building your own vault on day one, and write the rule that customer funds are never, under any circumstance, treated as company capital before you ever have enough money sitting in customer accounts for that rule to actually be tested under pressure. Every part of this video that comes after that, the trading engine, the listing business, the billions in float, is just what happens next if that one foundational rule survives contact with real growth, real pressure, and real temptation. There's one more layer of nuance worth understanding about revenue here too. Not all trading fee revenue is created equal. Spot trading from ordinary retail users is relatively low margin and highly price sensitive, since users can and do compare fees across competing platforms in seconds. Derivatives and margin trading, by contrast, often generate outsized revenue relative to the actual capital involved, because leveraged traders churn far more volume against a much smaller deposited balance, and because liquidation events, where an over-leveraged position gets forcibly closed, can themselves generate fee revenue for the exchange. That's part of why so many exchanges pushed hard into futures and leverage products, even while marketing themselves primarily around simple spot trading. The economics behind the two products are genuinely different businesses wearing the same brand. Owning a crypto exchange is, underneath all the technology and the trading platform branding, fundamentally a custody business. The fees are real, the margins can be extraordinary, and the growth can be explosive when the market is hot. But the entire enterprise rests on a promise that sounds simple and is brutally easy to break under pressure, that the money sitting in a customer's account is actually still there when they come to get it. Every exchange that has ever collapsed broke that promise first, quietly, sometimes for months or years before anyone noticed, and the balance sheet crisis that made headlines came only second, as the visible symptom of a problem that had already been true for a long time.